Okay, let's get ready for the exciting conclusion of our Chapter 1 video lecture. We're now going to take a look at how to prepare what's known as different types of financial statements. Our first statement will be a statement called the income statement. The income statement. This statement shows the profit or loss of a company for a specified period of time. The statement always it begins with a who, what, and the when. The who, the what, and the when. The who is the name of the company. The what is the type of statement. Lost my little cursor. Here we go. And the when shows the time period that's been covered by the statement. So this statement here would be for 1 year, for the year ending December 31st, we'll say 2024. This statement shows the revenue that was earned by the company. Remember, they earned $85,000. It shows the operating expenses of the business. They total $50,000. Because the revenue was more than expenses, they earned a profit known as net income in the amount of $35,000. Okay, so we're matching the revenues, the amount of money earned, against the expenses to determine whether or not they made a profit and or a loss. So this company made a profit this year in the amount of $35,000. So if revenue exceeds the expenses, we call that difference net income. However, if the expenses were more than revenue, that difference is known as a net loss. Okay? Our next statement is called the statement of change in stockholders' equity. This shows any change in the equity section of the accounting equation from the beginning of the accounting period until the end of the accounting period. So this is our first year of operations. So we began with zero in common stock, but then we issued common stock for $120,000. Then we earned net income of $35,000, but later we paid out $4,000 in dividends. So you got the $120,000 in common stock, $35,000 in net income, less dividends. So at the end of the year, our total stockholder equity will equal $151,000. So our equity went from zero at the beginning of the year. At the end of the year, total equity is $151,000. Our next statement is called the balance sheet. And what the balance sheet shows us is the accounting equation in a report format. Now, the balance sheet shows each account balance as of a specific date. Typically, that date would be the end of your accounting period, such as December 31st. So in the asset, we got cash, 51,000, land, 500,000, total assets equal $551,000. On the liabilities, we have notes payable of $400,000, common stock $120,000, retained earnings $31,000. Add those together to get total equity $151,000. And the balance sheet, like the account equation, it has to balance your assets must equal your liabilities plus stockholders' equity, and they do. Both sections total $551,000. Okay? So here we see those first three statements, the income statement, equity statement, and balance sheet. Let's discuss relationships, how each statement relates to the next statement. So notice that the net income or loss from the income statement goes to the statement of stockholders' equity. Then the ending equity from this statement is shown here on the balance sheet because we're now at the end of the accounting period. So we see how data from one statement is used to prepare the next financial statement. There's a fourth statement here that I haven't talked about yet. But that's going to be next. That's called the statement of cash flow. Okay? The statement of cash flow shows the cash inflows and cash outflows of a business for a specified period of time. It will indicate whether we had an increase in our cash account or if there was a decrease in our cash account. This statement is broken down by activity types. We have operating activities, investing activities, and financing activities. When you think about the operating activities, you're going to think about the daily transactions of a business, providing a service, selling a product, buying supplies, paying your rent. We're going to show the cash inflows that came from operating activities, the cash outflows from your operating activities. When you think about your investing activities, now thinking more about your assets, what we call long-term assets. What are those? So long-term assets typically focus on physical assets such as buildings, equipment, machinery, assets that could be used for a long period of time in order to earn revenue for the actual business. So we'll show money that came in from the sale of any of these long-term assets or the money that went out for the purchase of these long-term assets. Okay? Financing activities. There's what we call debt financing when you borrow money, or equity financing when you issue shares of common stock. So we'll show what money came in from finance activities, what money went out from finance activities. We'll then combine these all together to determine overall what was our increase in cash or our decrease in cash. Okay, so let's take a look at this statement. So for our statement of cash flow, we begin with operating activities. They show the money that came in, the money that went out from operating overall from operating activities. Our cash increased by $35,000. From our investing activities, remember we purchased land for $500,000. So from investing activities, our cash account decreased by $500,000. From financing, you borrowed money, $400,000. We issued common stock for $120,000 and paid out $4,000 in dividends. So overall, from financing, our cash account increased by $516,000. When I combine these three all together, overall, my cash increased by $51,000. My beginning cash balance was zero, so $51,000 represent the ending cash balance. That's the same amount also shown on your balance sheet. Okay? A few more topics. Permanent account versus temporary account. When an account is temporary, what it means is that account only shows information for the current accounting period. It's going to be closed to retain earnings at the end of the accounting period. So for example, your revenue account, expense and dividends are all temporary. What revenue shows, it shows what we earn for that specific accounting period. So revenue may show the amount we earned for the month of October. But when November comes, you begin with a zero balance. The same is true for expenses and dividends, and you'll learn more as we go about how do you close out what's called these temporary accounts. Okay? Retained earnings is a permanent account, so the balances from these three accounts is transferred to retained earnings, and that balance will carry forward from one accounting period to the next, meaning that my ending retained earnings balance for the current accounting period will become beginning retained earnings for the upcoming accounting period. Okay? So here we have those same transactions, and we call a horizontal statement module, showing how those transactions impact those different statements. So with the balance sheet, same thing. Here's your cash ending balance, land ending balance, notes payable ending balance, common stock and retained earnings, and the balance sheet still has the balance for the income statement. It's showing the total revenue. It shows your expenses and your net income. Statement of cash flow. We look at the cash transaction that you see here, and we show if they're a financing activity, investment activity, or an operating activity. And this is showing the change, net change in our cash account, which we know end up being 51,000. So you can see how accounting is all related, how those business transactions are going to be recorded, classified, and summarized. That data is then used to prepare these different types of financial statements. Okay? So these statements that we talked about are prepared in the real business world. Companies prepare on an annual basis an income statement, balance sheet, statement of cash flow, and an equity statement. So we're going to take a look again at a sample statement for American Company, my old employer. This is their sample income statement where they're showing sales. Sales is the same as revenue. They're showing their expenses, and these numbers are in millions. So you got to add behind the number 60. So their total sales in 2018 was roughly $42.2 billion in sales. Their net income or their profit end up being $6.2 billion. So the same thing we're going to learn in this class, you will see that same information used to prepare reports for actual live companies. Okay? So speaking of those companies like Merck Pharmaceutical, they prepare each year what's called an annual report. Those reports consist of the financial statements that we just covered today, what's called financial notes that you will learn more about, an audit report, we'll cover in chapter 4, and what's called an MDA, Management Discussion Analysis. I do recommend that you all take a look at the annual report. So let me ask you a question. What company do you shop at? Do you invest in? Do you work for? If they are a public corporation, meaning they trade stock on an open stock exchange market, then they have to prepare an annual report each year. So you can look up an annual report for Google, Tesla, Amazon, Walmart, whichever company you buy stock in. Look at the annual report and look at these different components that make up the annual report, because they must prepare this annual report on an annual basis. So I encourage you all to learn more about companies by taking a look at their annual report and the components of their annual report. Okay? So that's pretty much all we have for our Chapter 1 video lecture. So after reviewing these Chapter 1 lectures, you'll be ready to complete your Chapter 1 homework, your Chapter 1 quiz as well, and be sure to complete your introduction blog by the due date shown on the Chapter 1 module. Okay? Bye-bye.